The fundamental difference between an entrepreneur and a VC investor, VC specifically, is the investor is buying. As an investor, they're gonna buy a product, the investment, but it's gonna be one of the many investments they make. And so they're rounding out a portfolio, they're building a portfolio, they are adding it to the collection, whereas the entrepreneur is like, there's no collection, they're all in on one thing.
When you look at the outperformance of VC funds, what common characteristics do you see?
The few things we look for are a thoughtful portfolio construction strategy. When we started the business, we were trying to do good deals. Returning funds, generating return for LPs is actually not just deal hunting. It's deal hunting and constructing a portfolio from those deals. We look for firms and partnerships that are not just great investors, but thoughtful portfolio constructors.
What advice would you give a first-time fund manager out there raising capital at this moment in time?
Yeah, it's back to that it's similar to and parallels the advice to a founder raising capital, right?
Today on Conductive Conversations, Carey Lai sits down with Ben Choi, a venture investor, LP, and managing director at Next Legacy Partners. Ben was born in Peoria, raised in San Francisco, studied computer science at Harvard, and earned his MBA from Columbia Business School. Over the past 3 decades, he has managed more than $3.5 billion in venture investments, backing early-stage companies like Marketo and Course Hero. Before venture capital, he led product for Adobe's Creative Cloud and founded the startup Coffee Table, which he later sold. Outside of tech, Ben also took on a unique personal project that took him 6 years to complete. To find out what he built, make sure to watch the full episode. Let's dive into the conversation.
I'd like to welcome everyone to yet another episode of Conductive Conversations. I'm really excited to speak with our guest today, Ben Choi. And the reason why I'm so excited is because Ben has a really unique background. Let me explain. So Ben, when I look at what you've done, you've seemingly done it all. Venture capital, check. RE Ventures, In-Q-Tel, Storm, Mavron. Startup founder and CEO, check. Coffee Table. Big tech company exec, check. Adobe. And now, limited partner, check. Next Legacy. Just as a quick sidebar, for those of you who don't know what a limited partner is or an LP, LPs invest in venture capital funds. Venture capital firms take LP capital and invest that into entrepreneurs. And when the entrepreneur has an exit, whether it gets acquired or it goes public, all that money that comes back to the company is then dispersed to the venture capital firm. Then the venture capital firm splits the profit with the limited partner, 80-20 typically, 80% to the limited partner, 20% to the venture capital fund. And that's how a limited partner makes money. And that's also how the venture capital firm makes money. All right, now back to the show. So at Conductive Ventures, we invest in capital efficient, unconventional entrepreneurs.
Not box checkers, like me.
Not box checkers. When I look at your background, what I think is really unconventional about your background, at least for a limited partner, is I think you're probably the only limited partner that I've ever met that has all 4 of these combined. So most limited partners are capital allocators.
Yeah.
They probably did banking and became an LP. But I think in many ways, perhaps both big and small, all of these experiences, I have to imagine, kind of has informed how you think as an LP, which venture funds to invest in, maybe more importantly, not to invest in. And so I think what I'd love to kind of dig into is we're gonna structure this conversation into 4 parts. You haven't really seen any of these questions, but it'll be your career.
Okay.
Lots of questions on being an LP.
Yep.
Because I don't think most people know like what an LP actually does, right? It's a bit esoteric.
Yep.
I was telling Robin, if you asked me in high school what a limited partner is, I'd say, I don't know.
I know what a VC was in high school.
Exactly. And VCs are more prominent with Shark Tank now, right? I'm going to ask you some fun questions, and then finally we're going to end with Ben-centric questions. So I'd like to kick it off by starting off with your career, but I want to kind of wind the tape back to 1998.
98. Okay.
So you graduate from Harvard.
Okay.
First question. You grew up in Peoria,
Yeah.
Illinois. What was that like?
Peoria was, it's a small town in the middle of Illinois, about 3 hours from St. Louis and Chicago. It used to be known as like the slice of Middle America, and it represented like the taste of Middle America. And so actually plays would go do test runs in Peoria. And there was a saying, like I think 100 years ago, was, did it play in Peoria? Because if it played in Peoria, then it's going to do well for the general market. And for some time, apparently, like consumer brands would also test their products in Peoria. So it was a great Middle America town. I had a great time in Peoria.
And why were your parents there? What brought them to Peoria?
We were one of very few Chinese immigrant families in Peoria. The other like 5 families, and we knew them all, we'd have potluck once a month. They were either professors at Bradley University, the university in Peoria, or engineers at Caterpillar, which is where the headquarters were back then. My dad, with one child, when he had one child, he had finished his fellowship in allergy and immunology. And in the National Journal of Allergy, there was a little classified ad saying, doctors looking to hire young allergists to apprentice, and happened to be in Peoria, Illinois. So he moved his family of 3 to Peoria, Illinois, and ended up taking over that practice and built his career there. And I was a byproduct of that happy time.
So Peoria, I imagine, is very different than Silicon Valley.
Yes.
How do you think growing up in the Midwest has influenced or informed how you think?
I've just been so lucky in all the different stages and been able to enjoy each of these stages of my life. When I was a kid, from 0 to 10, I was in Peoria. And it just kind of, I think any 10-year-old or less than 10-year-old, your world is just what's right around you. So what was around me was school, my neighborhood. We had 7 acres of forest and as our backyard. I had my bike, and I could get around on my bike. And that was life, and it was just great and easy, and no worries. I had 2 older brothers. I had a very stable, loving family. It was lovely. We had hot summers, humid, freezing cold winters. One year the snowstorm was taller. Like, the snowbanks were taller than I was, and so I remember losing my snow boots, back in the snow. It was great. And then moving to California, we moved from that part of Peoria, Illinois, to right across the street from the Ferry Building in San Francisco. But this is 40 years ago, when there was a double-decker freeway and very few yuppies and no cool restaurants. It was just a very quiet part of town, but it was still in the city. And it was most importantly, it was about a 10-minute walk away from Chinatown, which is where my parents moved our family there so that they ran a small allergy clinic as a doctor and a nurse. And there was no Cantonese-speaking allergist in San Francisco, like one of the largest Cantonese-speaking populations in America. They just didn't have one. And so he went over to open an office and serve the Chinatown population. And so that's why we moved. So suddenly we went from like knowing all 10 Chinese families in our town to moving to San Francisco, where like, oh, lots of people look like me. And
I didn't realize that you grew up in the city.
Yeah, we grew up in like the red brick condos. For all the cool tech people who know San Francisco and Shack 15 and the whole ferry building area, if you look across, the tennis courts and little low red brick condos, and literally the one in the corner over the tennis courts is where my family moved to.
I mean, that's quite a contrast from 7 acres of forest.
Yes.
To dense San Francisco city.
Yeah. I mean, the biggest contrast I can encapsulate is, as a kid, riding my bike around. I assume my parents knew where I was, but I don't remember growing up reporting in. There's no cell phones or anything, obviously, back then. And then in San Francisco, I was free to roam and went around. But in San Francisco, you would walk through downtown to get to Chinatown, and I got mugged when I was 12 by some teenagers. Took my money and a chain that my grandma had given me. But like that doesn't happen in Peoria. It happens in a city, and it was all fine. And but that's a city experience.
Wow. I didn't realize you got mugged at 12.
Yeah.
You probably still get mugged now in San Francisco. I'm curious, when you go off to Harvard, do you have a sense of what you wanted to do when you graduated?
I'm the youngest of three boys. My parents were in medicine. My oldest brother decided, he's 6 years older than I am. He decided when we were kids that he was going to be a doctor, and he kind of was on that path. And so I knew as a kid that I didn't have to be a doctor. Like that's one thing I knew. And then my second brother knew early on he wanted to be an engineer. Just figured it out from Legos or something. And so he was on that path. And so I knew, like, hey, those boxes are checked. I don't need to, like, those are taken. I'm not going to do those. So I grew up, though, as the youngest of three boys with technology. My parents were very frugal and instilled us with a lot of frugality. Not as much as Carey Lai frugality, but frugality, except with one exception, they were lavish investors into our education. And somehow my brothers convinced them that computers and technology fit under the education bucket. And so I just grew up with a lot of access to computers. So I knew I wanted to work with technology, but it didn't need to be around medicine, and it didn't need to be literally an engineer. And I didn't know what the next thing was. And so it wasn't until actually at Harvard and after Harvard that I understood how big the world is around technology.
And so you knew you wanted to go into tech, but not necessarily as an engineer.
That's right. That's right. And so part of the reason why I did choose to go to Harvard was I went there planning to study computer science, but my second brother went to MIT down the road to study computer science, like where you're really serious about computer science. And computer science at Harvard, when I went, I was class of 98, so it was 94. I was, I don't know how many years, 20 years after Bill Gates dropped out, 15 years-ish, like way after Bill Gates dropped out from computer science. And Zuckerberg was 2004, so like before he dropped out and made it cool there. So I was in this kind of weird in between where computer science was a very small, sleepy little major within Harvard. And so for me, I wanted to study computer science, but I chose a school where it wasn't the main thing. Like it wasn't a technical school, and I was drawn to that.
Interesting. So what was your first job at Harvard?
First job was at a startup. Why I ended up there, because all the banks and consulting firms that recruited on campus said no to me. And I had a whole wall of rejection letters, and even like the few interviews I got, they said no. But a friend of mine and I went to an info session for a startup. We had no idea what it was, but they gave us like a free hoodie. We were like, this is amazing. We got free stuff. And I ended up, through lots of random twists and turns, working at that startup. So very, very random.
And did you actually do engineering?
No.
Okay.
I became a product manager, which I didn't know that was a thing. But by senior year, I had read one book, actually two books. So I'd read Startup by Jerry Kaplan, and then Soul of a New Machine, and kind of learned about this role of product management. So my career was in product management out of college.
So I want to kind of fast forward us to when you made the decision to become the founder and CEO of Coffee Table.
Mm-hmm.
You had been a VC for quite some time
mm-hmm.
at several different firms.
Mm-hmm.
And so, as we say in Silicon Valley, you decided to go to the other side of the table.
Mm-hmm.
And now you have to go raise capital.
Mm-hmm.
So I'm curious, this is probably, I think, the first time that you decide to raise capital instead of distribute capital from the VC side. What do you think that experience taught you, being on the other side of the table, which was the first time, right?
Yeah. My first time. Fundraising is sales, and I had never done sales either. I never done professionally. I did take a 2-week break during my startup career to work at Banana Republic because I'd never worked retail, and I had friends who worked retail during college. And I felt like that was a good experience. So I had 2 weeks of sales experience selling merchandise, but I'd never really done sales. And fundraising is sales. You're selling yourself, your company, and a lot of sales I learned through that process. And now, as an LP, having done this work that I do today for the last decade, a lot of sales is listening and understanding the needs or problems of the buyer, and then identifying how you can help, essentially. If you can help someone with what they want, with what they need, or help solve a problem for them, then that's a sale. But it's that framing was not obvious to me. And so in the fundraising process, when I started, I thought I just tell them what I'm doing, and if they want to invest, they'll invest because it's so amazing. And lots and lots of no's before the yes.
And what's interesting is you have sat on the other side of that table thousands of times.
Yep.
You've heard thousands of pitches.
Yep.
And one would imagine that the mirror or the inverse of that would prepare you.
Would be more obvious.
Yeah.
But I'm a slow learner.
What do you think makes it so difficult as a VC where you're judging others and whether this pitch is a good pitch versus a bad pitch, or whether you invest or don't invest, versus now you're an entrepreneur raising capital?
Yeah. I think, the fundamental difference between an entrepreneur and a VC investor, VC specifically, is an entrepreneur is all in on this one thing, and they're just trying to find an investor who will back them. But the investor is buying. As an investor, they're gonna buy a product, the investment, but it's going to be one of the many investments they make. And so they're rounding out a portfolio. They're building a portfolio. They are adding it to the collection. Whereas the entrepreneur is like, there's no collection. They're all in on one thing. So I think that mentality difference, there's a translation required to communicate between the two parties, and it's very doable. But when you put yourself in the mindset of the other party, that's, I think, the key translation.
Because you had that experience. You knew as a VC, as a buyer, if you will, what entrepreneurs were selling. And you would imagine it would prepare you, because you could play the reverse scenario of, if I say this is what I would think as a VC, right?
Yeah.
Yeah.
Yes.
In theory.
In theory, if I knew I was doing, yeah. I think, well, what you can't know as a founder is what you know what you have, but you don't know what the rest of the VC has. And you may know the logos, but you don't actually know where they, what risks they see, what opportunities they see in the rest of their portfolio, and how your company might complement, how an investment in your company might complement the rest of the portfolio. And so from a sales perspective, the fundamental job of the founder when they're fundraising is to listen and hear, like, what else, what are you interested in? What else, what's catching your attention as a clue to how this might fit the rest of the portfolio?
As you evolved your pitch and you went through the process, what did you kind of get keen on in terms of, this is way more effective? What did you find were maybe fundraising best practices as an entrepreneur?
So one of the biggest observations I had was one of the greatest strengths I thought I had going in was actually a weakness. I came from the venture world. I jumped over, and so when I went to raise, I knew a lot of VCs, and a lot of VCs knew me also, not necessarily as a founder, but just knew me. And so when I asked if I could come tell them about what I was doing, to see if they'd be interested in investing, the way you set those meetings up is you don't communicate a lot in the email or in the text or whatever it was. You just, like, do you want to meet with me? I'm doing a new thing. Would you like to hear? And the good news is that I had a lot of people to ask. The bad news is that because of a lot of goodwill, a lot of people said, yeah, but they weren't actually interested. They knew they weren't interested, and there's nothing bad about it. But because we had a relationship, they wanted to know what was going on, but I didn't really fit their portfolio. And if I could have known ahead of time, which is difficult to know, I could have prioritized better and caught up with them later, right? So I ended up having a lot more meetings that I probably could have skipped. And I think a lot of people probably didn't say no as fast as they might otherwise want to do out of respect for the relationship. So maybe as an investor, I definitely have a lot of empathy for founders and GPs fundraising, and try my best based on that experience to at least to be as transparent as possible. And that doesn't always, for investors, it doesn't always serve the investor well, because you always want, as an investor, you want to preserve optionality. If you might want to invest, you don't want to lose your shot at investing. So you try to play it coy. But I try as best as I can. If it's probably not right for right now, I try to offer that out.
Yeah. So you don't ghost
I
GPs now.
I try to. It's hard because it's a different volume game, but I try my best. That's my values are. I aspire to that.
All right. So you transition your career from venture capital to operator to limited partner now.
Yep.
How do you think about your journey when you look back on the 20 plus years? How do you think all these pieces came together?
Serendipity, God's grace. It's the most fun days for me are seeing the dots connected over long periods of time. When you learn something today and it comes up in conversation tomorrow, that's kind of fun, but that's not so surprising. When you learn something, you spend time with somebody. When I met a young Carey Lai 20 years ago, and then 20 years later, we're sitting in this really cool, set.
It's not my living room. People confuse that this is my living room. It's not my living room.
I get a lot of joy out of that. And I think one of that I'm sure there are many industries where you can have long relationships, professional and personal. But I think that pattern of relationships that span multiple companies, careers, professions, like over long periods of time, even multiple roles. I've been in different sides of this ecosystem. I think it actually is part of the secret sauce that makes Silicon Valley work so well. Right? It's not just coincidence. It actually is that those relationships and the trust that gets built at the personal level is part of how I think Silicon Valley is able to reinvent itself, take risks, try new things, reformulate. The human relationships are the underlying commonality, and that's what's fun for me.
Did you ever feel imposter syndrome? Because, again, as we talked about, going from venture to an operator and now LP, while you're right, it's the same ecosystem, but they're different roles.
Totally.
Yeah.
Totally. No,
How did you manage through that?
I feel it all the time today.
Even now?
Yeah, even now, for sure. There's this book I read, I think in high school or college called The Cuckoo's Nest by Cliff Stoll. It was it was a true story about, I think, a guy here at Berkeley who ended up finding a hacker back in the 80s. And he worked at a lab, but his role was somewhere in between the scientists and the IT team. And the scientists always thought of him as like not a real scientist, kind of the IT guy. And the IT people would think of him as, you're kind of like the science part. And he was kind of in between. And today we would call him a product manager. He's the in-between person. But that always resonated with me as, I grew up in Peoria, Illinois, but I look very different from everybody else in Peoria, Illinois, a child of immigrants. And then we kind of had the funny looking lunch and all that stuff. But I'm from Peoria, Illinois, and I moved to San Francisco where everybody's like, all my old community, we moved next to Chinatown, lots of Asian people, but I'm the kid from Peoria. Like, that's weird. Go to Harvard, study computer science. Like, this little weird major. Nobody does computer science. Today, it's the most popular class for freshmen, or actually in the whole school, CS50, Intro to Computer Science. So I've definitely identified as like the minority, I guess, which I think is tied to that imposter syndrome. And certainly, like, just going to college, you meet all these really impressive on paper other kids, and I look back and I realize, like, we're just all kids, but they all were really impressive in high school and got into this cool school. I definitely felt imposter syndrome then.
I'm curious if you think that if everyone feels like a bit of imposter syndrome, no matter how amazing they look on paper.
Yeah. Well, I don't know. I think they all should feel it. That's a question of your own, like, of your own.
I guess it depends on how self-aware you are.
Yeah, exactly. But it's certainly how I'm wired, and it's a source of fear and uncertainty and doubt, and still is today. But today, I think it was just that earlier in my life. Certainly, many of my friends and I during college went through a lot of like late night conversations talking about this. But I found professionally that it's also a source of strength. Being different, actually, when you're rewarded for contrarian thinking, if you're right and contrarian, which is what venture industry is, and what startups are about. Like, these are crazy people doing things that the market disagrees with to start a company. And if you are right on top of that, then there's handsome rewards for that. That's effectively you should feel like an imposter. Like you should feel different amongst the world you're trying to navigate.
Is there anything you miss about venture?
Being on the GP side, you mean?
Yeah.
I think the privilege of being a venture investor is the journey you get to have with founders and the relationship you get to have with founders. As an LP, we get to be around them, but it's fundamentally we're not there at the same level of frequency of communication relationship as GPs can and should need to be. I think that's what I miss. Sounds like I regret not being able to do that.
No regrets.
But yeah, it's a special thing. It's
clearly you don't treasure the relationships you have with GPs like you did with CEOs and founders.
It's the thing that I found most precious in the GP role was spending time with founders, and again, like through the good and bad times, both. Right? It's really fun to celebrate and like pop the champagne bottle when you're celebrating some big milestone, but like those celebrations are only special if there was hardship along the way.
I agree.
And there's by definition, there's always hardship.
Yes. Same question. As an operator, anything you miss?
As an operator, you are so close to ground truth that you're inundated with information, but you can learn so fast because your cycles, you don't have to wait for anything. You're like right there. It's up to you how quickly you want to learn, but there's no intermediary filter. You don't have to wait for the next board meeting. You don't have to wait for the next call with the founder. As an LP, you don't have to wait for the next annual meeting or meeting with a GP to hear about the company. If you're running the company, you have every opportunity to have incredibly fast learning cycles, and that was just super fun for the limited time when I was CEO and running my own business. Like, it's one thing to be in a startup, which I had my career in startups early, right out of college, and it's super fun and exciting. But I was fed the opportunities. I was put in place of the opportunities, and so I just had to scramble and learn and make the best. And it was always a privilege. I learned a lot. I'd always change jobs every year and a half to 2 years, because either I failed or the company failed. Once in a while, something succeeded and we'd move on. As a CEO, though, the exciting part on top of that was like realizing, I've got to decide which area I'm going to focus. Where am I going to spend my time learning? I've got to do that for the rest of my team too, and help and direct them so that they're in a place where they can be learning and growing. And that all was really, really hard. I had no idea what I was doing. I didn't know that was a thing even. And so just all of that was just really, in retrospect, very rewarding.
So do you feel like what you're doing now at Next Legacy, has it been 10 years?
Mm-hmm.
Okay. It's been a decade. Do you think it's the best thing ever right now?
It's an incredible privilege. What we get to do, we really do feel like we serve our investors. And we get to serve them by working in partnership with incredible founders and GPs. When I try to describe to my children what I do as a day job, ultimately we are a glorified middleman.
Maybe they'll get more insight once they listen to this podcast.
Maybe not after what I just said. But I say that somewhat jokingly, but also like with full self-awareness. Like, it's a privilege to do what we get to do, and we couldn't serve our investors if we didn't get to partner with founders and GPs who are successful, and we couldn't do it if we couldn't have a portfolio, because not everything goes up and to the right. There's plenty of failure in with our partners, and so that's an incredible privilege. It's super fun.
If you weren't an LP today, what do you think you'd be doing?
Oh goodness. I guess I would probably roll back to the GP side. I think especially today, it is so exciting what's happening in technology. And I feel like we're in overtime. Like, we're not supposed to get a third shot at yet another like significant tectonic shift in the technological landscape. One that is clearly, who knows how big it'll be, but it's clearly going to have is clearly bigger than the tech industry. Like this stuff, artificial intelligence is going to and is already impacting broad industries of the world. Some people in this context that are close to it, I think, are drawn to like, oh, I want to start a company. Like, I got to get to work. I'm really drawn to like, oh, I want to be around that in a portfolio way. I honestly, getting into 2000 LP is incredible. If I couldn't, if they wouldn't let me run the LP side of things, then I'd go to the GP side next.
And I just want to let you know that I actually formulated all these questions without the help of
ChatGPT. Did you?
100%.
No way.
Yeah, I did.
Is that a good or bad thing?
I think I'm naturally curious
Yeah.
as a person.
Yep.
So it's not difficult for me to formulate questions, but questions will come in the gym when I'm doing something.
And you remember them, or do you?
I immediately just put it down as a note. Yeah, I usually do voice to text, and then I have a running list. Then I have to go organize it because it comes out as a bunch of random questions, and so I have to add some structure to it. That's my process.
And you do it all manually yourself.
I do. What I will do is I'll throw it in ChatGPT.
Okay.
Afterwards, because I almost see it as like a comparison. I'm just curious to see. And yeah, there weren't any questions that I thought were necessarily better than the ones I had created. There are 4 pages of questions here.
There's a lot of questions.
I know. Like I said, I'm curious.
You are.
I have a lot of questions.
This I know, but I'm impressed.
I'm in the best job ever because I just ask a bunch of questions. I always tell my founders, I may not always have the right answer, but I have a lot of questions.
I like it.
I'm in the best. Yeah.
It is, and you get to meet, and when you work with a set of founders in your portfolio, but your day job is meeting with new founders, constantly looking for the next deal.
Yeah.
And I think what's so cool about your job is you get to learn from founders who
100%.
are passionate about something very different from the next person.
Exactly.
It's so cool.
Yeah. I think that purview is amazing.
Yeah.
And so I love learning, and the fact that you can place a bet on something and really have conviction around an idea, a founder, a team, that part is really cool. Because otherwise, you'd rather just stay in academia and just research.
Yeah.
And that just, to me, does not sound very fun. So I'm curious, when you look back at your career so far, any regrets? Anything that you could have done differently?
Oh, so many mistakes. I'm not wired for regret, because I think even things that I think I would have wanted to do differently, often things I wish I had said differently or didn't say at all. The way I experience life and think about the past is like those are all the opportunities that I learned from, and if that hadn't happened, then I wouldn't be where I am today. And I feel very lucky to be where I am today. Not that I have some amazing life. I just feel like it's a blessing to be put in the relationships we have and the opportunities we have, and a responsibility to kind of make the most of those.
All right. Okay, we're going to move on to LP questions.
Okay.
This, I hope, doesn't come off too esoteric for our audience.
Yeah.
But at the same time, I really feel like to really understand entrepreneurship, venture capital, you really need to understand where all the money comes from. And so I want to, saddle up. We're going to do a deep dive into your LP world. So one of the things I observed is Next Legacy,
Yes.
I think, is pretty unique because you guys invest in first-time funds,
Yes.
which isn't very common for LPs.
Yep.
I think it's a unique trait because, for better or for worse, I think most LPs tend to be risk averse naturally. And what I mean by that is LPs would probably rather invest in a franchise that has had multiple funds under them. So think of a franchise fund like an IVP or an A16Z or clearly a Sequoia. But at the same time, what I'm really curious about is if that's sort of the natural instinct of the majority of LPs, why do you want to invest in first-time funds? Why do you think there is money to be made in first-time funds?
The rationale for first-time funds is twofold, and every LP is different on how they weigh these two things. But one is there is a thesis, an investment thesis, that GPs, first-time GPs, are hungriest. They have the most capacity. They don't have any board load yet, and the fund size is the smallest it's going to be. So it's relatively small, regardless of where they start, relative to their strategy and their fund size. So, and all those things are ingredients for the potential for outsized returns. So that's an investment thesis. The other part of it, though, is and this is what may not be as obvious to GPs on what the LP business is. Just like founders need to understand GPs are running a portfolio, GPs need to understand that LPs also are running a portfolio. And there's a wide variety of how LPs think about the portfolio. But ultimately, every investor has to do a risk-reward trade-off, and what kind of diversification you're looking for in your portfolio. And first-time funds, separate from the investment profile of itself, they can be a way to build a relationship, start a relationship for future access. And that's a unique thing in venture capital, unlike almost every other asset class, where there are very few investment products where you have two jobs. First is to pick, and then second is to get access. And almost every investing job, your job is picking. Like you want to buy NVIDIA, you buy NVIDIA. There's no access to NVIDIA. There's no constraint on access. But you can pick Conductive Capital, and that's the first step.
Conductive Ventures,
Conductive Ventures,
but appreciate it. Thank you.
Yeah, so
Thank you
pick
for the plug.
Venture, and then, but the second step is, so if you can pick Conductive Ventures as a selection criteria as an LP. But the second challenge now, which is strange in this unique asset class, is now you have to get access. And how much access? Like, hey, you got your X million dollars of allocation. That's might be what you want today, but you may want 5 or 10 or 20x that number in a future time. So that progression is additional math that LPs are doing. First-time funds start the clock on that process, however the process works for that LP and the dynamics of the firm that they're investing with, honestly.
I think what's interesting about what's happening to the venture capital industry is in many ways a pretty dramatic shift from the way it's been done, which is more like a cottage industry when you and I both started over 20 years ago.
Yeah.
And what I mean by that is...
Beyond to go.
Yeah, I know, right? What I mean by that is you've got firms like Lightspeed and Andreessen that are becoming RIAs. Mm-hmm. General Catalyst, we'll throw in there as well. Mm-hmm. Why do you think this is happening? Why do you think these venture funds are raising much, much bigger funds? And why are they transitioning into RIAs?
The RIA, I have less insight into. There are a couple of different aspects of that. But why scale up as a venture business? I think there are two reasons for it. One is the maturity of the technology industry is at a point where the potential outcomes are larger today than they ever have been in the past, exponentially larger. And since that is true, then the return potential for an early stage investor is exponentially larger also. One version of a non-responsive industry would be, well, that means returns will go up. But this is a competitive landscape. And so there's opportunity, capital is flowing to that. And so those firms believe that they can deliver comparable performance to decades past on much bigger dollars, much bigger funds, because the parallel outcomes are so much larger today than they were 20 years ago, that they can generate the same scale of returns on these large dollars that we used to be able to do as industry on these small dollars. Like, that's one thesis.
Do you believe that?
Outcomes are bigger.
Personally?
I do, only because we are living it. Like, look at everybody on the podcast listening, who honestly would have thought that we would have a single $1 trillion business, let alone however many we have today, 4 or 5, and all of them technology companies. Like, that is unfathomable just a decade ago.
But Jensen Huang at NVIDIA did not have a multi-trillion-dollar company overnight.
No, it took a long time. Took a
Long time.
Took a long time. So there's so the question is, how fast can you get there? But we are seeing companies achieve scale faster and at a larger scale than ever before, at all scales. And I think the fact that the hyperscalers have been able to achieve the market cap they've been able to in the public markets is a big part of that story in the private markets, because those are venture-backed stories. They're decades down the road, to be clear. That's true. Took a long time to get there. But the newer ones are getting there faster than these established ones ever got to. And you don't need $1 trillion outcome to justify those funds. You do need hundreds of billions of dollars of outcomes, which it would be unfathomable to talk about 20 years ago when we started, but is actually, I believe it because it's the facts today. That doesn't mean that they'll all be successful.
Right.
And doesn't mean that the odds of hitting one of those companies in the time frame necessary to deliver comparable results is guaranteed by any way, but venture business is not guaranteed at all. So that's one answer.
That's one. Okay.
Technology, the size of the pie is bigger, and so fund size bigger. I think two other reasons. One is the amount of capital, in the asset allocator world, the dollars under management are massive, and they've grown exponentially from not just from tech, just over time it's grown. And so desire for the alpha available in venture has grown larger and faster than the venture industry could have naturally done. And so there's just an artificial injection of capital. And so those funds also—
Don't you think that depresses returns though?
It is a deflationary force on returns, for sure.
I mean, it's supply and demand.
Yes.
Yeah.
So it'll push returns down relative to where they would be if that money didn't exist. But that's the alternate universe that we don't live in.
Fair.
And that was true 20 years ago too. If less money had gone in, if the last dollar hadn't gone in, everybody would have made more. But who gets to stop the dollars, right? There's pressure for dollars to go into this asset class, and there's the other countervailing pressure of exponential growth of technology companies, both in size and speed. And those two things, the question is, which force is going to overcome the other? For average returns, even if average returns go down, you still have potential for outliers in this business to way outperform, even if there's an overwhelming scale of dollars, flood of capital coming in, depressing returns on average. Third reason, though, I'll put out there, and then you can debate me on it, because I think that's the theory, right? And we'll see how it plays out. The third reason, though, is I think there are some of these firms, and we were privileged to partner with some of them. I think Andreessen Horowitz is the first. We were in their first fund as a fund one, and they were not the scale.
How big was that fund?
A couple $100 million, maybe 250. Since this is going to be a podcast, I'm sure somebody will correct it, but somewhere in that range, couple $100 million. But they did have the idea that they would take the Mike Ovitz model of an agency, and which is now they consider platform services, to support the portfolio. That was a novel idea back then, and that was a big part of why we added them in as a fund one to complement. It was complementary to the rest of our portfolio.
Sure.
And that now is the standard in the industry for to be value add beyond just the network of an individual GP. You bring to bear the resources of a firm. Part of the rationale, taken to the limit of that concept, a larger firm can invest more management fee into building out those services. And so today, Andreessen Horowitz has 500 plus employees, and overwhelming majority are not the investment team. They are the rest of the machinery that adds value to those portfolio companies. And that's the theory of, and that's part of the theory of rational of having a larger firm and larger fund size.
Yeah, I guess for me, on your first point, I think their last fund was $7 billion.
Series of funds, yes.
Yeah, I get the fact that they raise a big fund and then they just chop it up into early stage gaming fund, crypto, whatever.
They actually have multiple different vehicles.
Yeah, multiple different vehicles.
Mm-hmm.
I guess my question, and that I wonder, and we'll find out the way it plays out over the next 10 years, is can you 3 to 5x $7 billion? That's a question.
Yeah.
I don't have an answer to it, but my sense is if you just simply do the math, I don't know if owning at the end, when a company goes public, owning whatever their average ownership is in those companies, because this isn't buyout where they own all of it. or a majority of it, if there's enough, if the math works where they can 3 to 5x $7 billion. That's my question.
All the math that it's a large, there are more zeros today than on smaller funds, for sure. And the two pieces of the pretty simple math that even our kids can do, turns out it's hard to execute on this, but can you have a slice of the really, really big outcomes, the world-changing outcomes, and that will generate some large multiple on small dollars, which average across a larger fund can generate multiples on the fund. We call them dragons. So can you return the fund with one investment? So a small investment that's outsized return can do it. And then for the later stage growth investments, and some of these investors have done well. And you trained at IVP and kind of set the bid for this, where you're going to be later stage, you just concentrate more, right? And so you write a bigger check relative to your fund size, you concentrate more.
Yep.
And so you're not looking for 100x
Right.
multiple on a one fund,
Right.
one company, right?
Right.
You generate outsized returns on your fund with a lot of 3 to 5x's. You can get a 3x fund with a handful of 5x's and one or two things that don't work. You're still taking risk as venture,
Yeah.
but you don't need the same 100x profile for that to work at the later stages.
Yeah, I guess my argument around that is with the number of later stage growth equity firms that have come into the market. When I first started, there were only 4 firms that did later stage. And I remember LPs consistently asking, I have early stage and I have publics. What is later stage? And there were only 4 firms at the time. Now you have hedge funds, the folks that have been doing it. Like it seems like every early stage firm has a later stage vehicle, opportunity funds, SPVs,
forget hedge
everything.
funds. Half the LP dollars that go into venture are in late stage venture funds.
Yeah.
So, and that doesn't count hedge funds.
Well, they consume more capital naturally.
Yeah, they consume it. But that's the scale of it today. Half the dollars are in late stage venture. And it used to be this tiny little portion. It was the outskirts.
Yeah, it was the outlier.
Yeah.
It was like the people didn't fit into a nice, neat bucket.
So, Carey, did you feel imposter syndrome when you were at
I did not. I was just thrilled to have a seat in venture capital. My goodness. I was the only analyst with 6 partners at the time.
That's incredible.
And I learned a lot, and it was like drinking from a fire hose, and I loved it. Absolutely. I still love it. I mean, I always tell people this is like the best job in the world. I could not have constructed a better job. And I didn't even know this thing existed when I graduated from UCLA. It wasn't until I worked on my first IPO as a tech investment banker. So kind of like you, I loved technology and I knew I wanted to do it. My dad's an aerospace engineer. My mom's a programmer. So tech is in the family. But I took my first programming class at UCLA and I had this like recurring circuit that I couldn't figure out. And after 2 hours, I still couldn't figure out. Then I sent it to my buddy.
You didn't ask Copilot?
There was no Copilot. The Copilot was my buddy on the phone.
You phoned a friend?
It was. And he was like, oh, it's like boom, boom, boom. And I was like, I knew right then and there, I'm not going to be a programmer, but I love tech. And so for me, it was coming to Silicon Valley, working on my first IPO. And what I loved was, I remember on this drafting session, I was working with the CEO, founder of this company. It was a software company. And I loved his stories. He was just full of stories. And I remember thinking to myself at 22 that I want to hang out with these kind of people. I don't know what they're called. They're called founders. But he's so different than like the CEO of HP or the CFO at HP that I had met with the prior week.
Yeah, for the road
It
trip.
was so inspiring to just be in his presence. And it was later, as I did more deals, that it's called venture capital.
Yeah,
And that's how that was my journey.
love it.
And then I just never left.
Yeah.
I tell people I'm like probably not good at doing anything else, having been in venture now for over 20 years. Just kind of crazy.
Well, part of the dynamic that I'd love to ask you about is, we're comparing versus 20 years ago, and back then there were only 4 competitors to IVP, or at the growth stage, which is a relatively small portion. And in the venture world, there are only, I don't know, like a couple hundred venture firms. Today, there are thousands.
Yeah.
It's not just because there's more dollars. With more dollars from LPs coming into the asset class, there are so many more GPs out there. It feels like the pace and competitive nature of the work seems fundamentally different than it was in years past. I'm curious if you feel that way.
I think at IVP, it was always competitive. And so I tell our team that you have to be fast, but not sloppy.
Mm.
And that was something that I picked up at IVP that I completely believe in.
Mm-hmm.
I do think that speed is an advantage.
Mm-hmm.
I still think that today. I think because we look at very, very different deals,
Mm-hmm.
it's not the same kind of frenzy that I think most firms experience.
Mm-hmm.
And what I mean by that is we don't chase heat.
Mm-hmm.
I know a lot of firms are like, oh, there's something here. Let's just pile on capital. Who cares about due diligence? Like that firm did it, so we should just mark it up and do it. And that happens a lot. There is a lemming effect.
Mm-hmm.
And we are the complete opposite of that. We don't care who backed you. We don't care which fund was or wasn't on your cap table.
Mm-hmm.
We look fundamentally at the business.
Mm-hmm.
And fortunately or unfortunately, that just takes some time.
Yeah.
And so we really do the work. And there was a competitive deal, Robin, who's, helping us out with this. We looked at this deal and the firm that ultimately did the deal paid 2x more than us. And we're still scratching our heads. How did they get there? I mean, we were talking about it yesterday. We're like, how there's just no multiple that justifies, if you believe that the ARR of this company
Mm-hmm.
is, you give the entrepreneur
Yeah.
full credit.
Yeah.
And you apply the most generous exit multiple, maybe barely squinting, you might get there. But we just couldn't. We just didn't get there at all. We just weren't even close. And we're okay walking away from a deal if it's too expensive.
Do you think you have a similar portfolio construction and fund size strategy to that competitor?
They're bigger than us. They have a bigger fund than us.
I think that's ultimately it's not directly correlated to fund size, but just different fund strategies can pay different prices.
That's true.
You have a different risk appetite. You're underwriting to a different kind of return
Exactly. So
on any individual company.
So that's what it comes down to is what are we underwriting to and how much margin are we willing to underwrite?
That's right.
Because we all know things don't get executed perfectly.
Yeah.
Very rarely actually does a company hit its ARR target.
Yep.
And when you fundraise as an entrepreneur, this is the best possible outcome. And A plus B and C all have to go right to enable us to hit that ARR 2026 goal.
Yeah.
That's like dog years
Yeah.
for a startup.
Yep.
And
Especially today.
With so much change going on.
Yeah.
And you have to underwrite some amount of margin. What if C doesn't happen?
Mm-hmm.
What if B doesn't happen? Mm-hmm. Then we're at a lower growth rate. Now are you in a situation where you overpaid? I'm sure you see this a lot with funds today. Like there's a lot of firms that probably have significant markups from 21, 22 that I'm sure as an LP, you're kind of like, I don't know if I believe that markup.
We're getting far enough along now in 2025 where if we see it, something held a last round price from Q4 2021, yes.
You're like,
really, that's a review, but the reality is everybody has audited financials, and maybe you got through Q2 2022, but by 2023 Q4, auditors are looking at those and saying, you got to apply your valuation policy, and if it's a 2-year-old mark,
right,
especially if it's significant, that means it had some revenue. Hopefully, if it has no revenue, then that doesn't hold up.
Right.
But if there's some revenue, multiple has changed, and so we've generally seen the correction in pricing. Occasionally, there's the exception, and it makes for interesting conversations.
I'm curious, when you look at the next 10 years, do you have any predictions on how the venture capital landscape changes?
Oh, predictions are so hard. when we started back 20 years ago, I thought, so I graduated from business school in 2005. I interned at a venture capital firm during business school, and then that was in New York, and then started my career out here on the West Coast. And I was pretty excited because I felt like, oh, this is great. We're 5 years past the dot-com bubble. Like Google had just gone public in 2004. Like we're in a new era. Like all that, whatever excesses had happened in the old stuff, those firms must be all washed up and gone. And anything that's live today, it's like there's supposed to be less noise in the market. And I think it took another 5 years for a lot of the firms that had some success in the 90s to fully go away. They may not be actively investing, but just because their fund isn't actively investing doesn't mean that they don't like hanging out at demo day and talking to founders, and you're still trying to compete with them to get attention from the founders to talk to. And they might even, take some meetings and pretend like they're going to invest because maybe they have one more check, but they'll write it over the next 5 years. So that noise in the market lasted a lot longer than I thought it would. Having experienced that, you would think that 4 years past that peak of, 4 years past that market peak that we experienced in public and private markets, that things would all shake out. We've seen it shake out on valuation methodology in the portfolio, but there's a lot of capital that went into the market. A lot of those fund managers that were new managers over the last decade, they probably won't raise again or won't be as successful raising, but they'll still be out there. They still have fees for a while. They're still going to go to all the different events, and they'll still sponsor things here and there. There's so many of them that somebody will sponsor something. So there's just, I think, will be a lot of noise for quite some time in terms of investors, like the investor landscape, which makes it interesting and challenging to navigate as an LP. I think it's also challenging for founders too to navigate.
I completely agree. I feel like whenever I help my founders when it comes time to fundraising, it's really giving them cliff notes about, is this fund actually investing?
Yeah.
When was the last time they raised the fund?
Yeah.
What was the last investment they made?
Yep.
Is it a stale fund or?
Yeah, absolutely. Yeah. Those are all things that founders shouldn't spend time, they shouldn't be aware of that stuff. They build their company.
That's right.
But hopefully you can find that perspective.
Yeah. That's interesting. Yeah. When you look at what's going on in the LP world, right? We're seeing Harvard, Yale starting to get some liquidity. I think this is the first time in history, right? And you can credit Yale's endowment model as, from an asset allocation perspective, as sort of being one of the earliest ones to not only invest in venture, but private equity. And now they're, because of what's going on, they are now seeking liquidity for their positions. What do you think is going on when from your LP lens? What does it mean? What's going on?
So I can offer some hypotheses. I am the teams that run the private portfolio and the CIOs there are friends and peers in the LP world. So
full disclaimer, they have not told you anything.
They've not told me anything.
Yep. Okay.
And I do think that they are wise, right? These are not.
And you donate to your alma mater.
These are not random occurrences. They are actually doing things wisely. I assume, right? So I don't have inside knowledge. Part of the dynamic is that secondaries are actually a natural tool for liquidity, and these mature programs that have tens of billions of dollars of exposure in long-term illiquid investments naturally use secondaries as a tool for liquidity. Right now, there's a greater demand for liquidity because funding sources from all different places are up in the air. They're not turned off yet necessarily, but it's not as clear. So from a conservative standpoint, it makes sense to increase your liquidity profile. So I believe part of those headlines and the news on those two universities doing secondaries is actually part of the natural annual thing that they do. And so there's a pretty thriving secondary market where you can sell your interest in this fund or that fund. You sell it at a discount, but dollars today versus possible dollars in the future at an unknown price is a reasonable trade-off when you need cash. That's part of it. I do think part of it also is it's an opportunity to clean up some relationships. And if is it Warren Buffett's quote of you don't really know who's not wearing swim trunks until the tide goes out?
Yeah.
when the market was so hot during COVID, as an LP, it was very difficult. And we said this out loud to ourselves. We can't see what's going wrong here. Certainly things are going wrong. Like there's clearly problems in the portfolio. That's by definition, that's how venture works. Not all these companies are doing this well. We just can't know today because there's too much injection of capital. There's too much noise in the system.
Do you still feel that way right now?
It feels like we're in a much healthier place than we were during COVID in terms of the balance. There's a lot of optimism, potentially some froth around AI. But there's also a lot of concern and skepticism, which is healthy, right? And so there's a natural push and pull. So I think...
You don't think GPs are always just hawking the next best thing? First it was mobile, then it was cloud.
That is the job.
Now it's AI.
That is, I think, not the job of the GP, but it is a natural part of the industry. And so I think, everybody should have some skepticism around when others say like AI is like, this is the biggest thing I've ever experienced in my career, or this is truly going to change the world. Yeah, I think that's natural.
Future of work 4.0.
You're saying it's the fourth time we've said this, right? It's like we're going the third time.
You keep falling for it, Ben.
You can be skeptical. Well, but you look back and it is incredible. .com was a bubble for sure. But was the underlying claim right or wrong? Did the internet change the world? Yes.
100%.
100%. There's no question in hindsight. It's only 25 years later, but 100%. Mobile, and that's the era that we grew up in venture, right? Mobile is a thing, and then you'd have mobile specialized funds. You have partners specialized in mobile. Should we do, what's your mobile strategy? It turns out mobile is just the internet. It's just part of it. 15 years later, but mobile fundamentally changed the world.
Yep.
And in very tangible ways, it passes the mom test very quickly, right? My mom used the phone, used apps on her phone, all those things. Cloud is a little less obvious, not for consumers, but from inside the industry, there's no question cloud was a fundamental revolutionary thing, changed the nature of building and technology and the OS of business, period, right? I think with hindsight, 10, 15 years later, we can look back and think these are non-controversial statements. I think skepticism is healthy. There's definitely overhype within AI, but I think the high level prediction that this is another one of those will be very easily non-controversial in 5 years. In a short period of time, we can look back and say, yeah, that had a big deal. I think that the main question that VCs have to navigate and founders have to navigate is what's the order of magnitude that this will have? Is this an internet, a mobile, a cloud, or is it 10 times bigger than that? And if it's 10 times bigger, then as a founder, you need to go swing 10 because your competitors are going to go after a much bigger target. So you got to go swing bigger. As a GP, same thing. You got to calibrate your thoughts on how big this could be. Partially defines how big of a swing you can take, how much upside there is.
I guess as an LP now, from the vantage point that you have, what wasn't evident to you when you first joined Legacy Ventures, which obviously has now become Next Legacy?
Yeah.
But what was not evident to you?
Well, I say this partly in jest, but my partners, when they were sharing the opportunity to join my firm with me, told me that it's incredible as an LP because you get all the data, and it's true. We have a lot of data. We get all the financials from many firms, so we get breadth. But it is so noisy. So one of the biggest surprises I got day one was oh my goodness, I get to see performance of all these people, but the information is so inconsistent across firms, and both in quality and depth. Even the fundamental metrics that are reported are different. That it's actually you navigate with a lot of the work in LP world is normalizing and rationalizing, making sense of this information. There's a lot of it, but it's not nearly as cut and dry and arithmetic as I assumed it would be.
So let's say what you're saying is there's 25 pieces of data, but some firms only give you, let's say, the first 7. Other firms give you 8 through 10. That's one dimension. So slice of time, Okay.
Like you just get, it's hard to compare this firm with this firm because
Okay.
what you get is different.
Okay.
That's one slice. The other slice that's more fundamental just to the business of LP investing is hypothetical story of here's this great firm. They've got this great performance. Look at this performance. Almost by definition, the people who wrote those checks 10, 15 years ago are less active today. The majority of the people writing checks today usually are not the people who drove those returns. Almost always, firms that have that success now have grown their fund size. Maybe it's because they just naturally grow, or it's because the industry has changed, or because their strategy has changed. Like usually a lot of things have changed in the team and strategy and fund size and the firm today than what was the case when the successful funds that have performance, were first invested. It doesn't mean like by definition you don't correlate them, but there's this very loose correlation that the LP needs to make between history and current reality, and then do that times the 25 correlations that we have.
So I guess that actually is a great lead into my next question, which is when you look at the outperformance of VC funds, what common characteristics do you see?
Yeah, I think there's the few things we look for are a thoughtful portfolio construction strategy. Like these are when we started the business, we were trying to do good deals, but returning funds generating return for LPs is actually not just deal hunting. It's deal hunting and constructing a portfolio from those deals. So we look for firms and partnerships that are not just great investors, but thoughtful portfolio constructors, because that's how those outlier returns get translated into LP returns within those funds. And then on that first, the table stakes is, are you a good investor? And the patterns of good investor that we see are one of three dimensions. You're incredible at deal flow, you're incredible at investment insight, you see something that others people don't see, or you're incredible at value add. And it's never one of those three things, and they meld together, but we tend to see spikes amongst one of those three things as the differentiator for successful investors in our portfolio.
And is there one of those three spikes that tends to lead to outperformance more so than the other?
No, we've been doing it long enough and have enough experience with enough firms where we've earned a lot of humility. We've got a lot of genius ideas, and we work with people with a lot of smart ideas. And you've got to be, thoughtful, smart, talented, and a little lucky too, or a little not unlucky, right? And all those things mixed together. So we've seen success in all three of those different dimensions as an investor. We've seen different models of success with different portfolio construction strategies. So it's not like my answer wasn't, oh, this portfolio construction is the way that you generate outsized returns. We've seen large portfolios with low ownership be successful if you have the right power law of returns in there. We've seen more highly concentrated high ownership models work. We've seen multi-stage, we've seen single stage, single sector, multi-sector, large partnerships, small partnerships. We've seen a wide variety of models have success. We've also seen those exact same models be unsuccessful. And so the job that we have that's interesting and fun, the challenge we have is really try to pattern match the success to those things. It's never one-to-one. You can't just say, well, just do this and it'll be successful.
So it sort of starts with portfolio construction, but sort of backed up by, are you a good investor?
At the same time, I'd say.
Yeah. Okay.
Two things at the same time. Must be one. And back to your earlier question of what wasn't obvious, it wasn't obvious to me, the portfolio construction stuff. I think that's the most surprising thing to GPs.
Interesting.
That are new in the business. Because when you're new, you're just trying to be a good investor, which is really hard to do. It's hard to be a good investor.
Right.
It's hard to stay a good investor. It's like, especially in a competitive environment. But to generate great fund returns, you have to have great investors that work within a system, a firm that can create great portfolios. And that's the piece that I think is there's a lot of art to that. There's some simple math, but it's just not a practice that junior investors need to spending time.
Do you think the funds, I'm sure you guys have invested in funds that did not work out.
Mm-hmm.
Do you feel that didn't work out because of these reasons? Bad portfolio construction, bad investor?
The only common scenario only commonality that we can easily draw a correlation with kind of bad performance is partnership politics, unhealthy partnerships. And every partnership is different, so there isn't like a magic formula for a healthy one. But one of the things we focus on as LPs is being in relationships, spending time with our GPs. We haven't figured out the magic formula for the successful ones, but we've started to see the patterns for the unhealthy partnerships.
How do you tell as an LP? Be honest. How often are you in relationship with these GPs outside of the annual meeting?
Oh, well, outside of the meeting is an important part of. I think there are a lot of asset allocators where you go to annual meeting and your relationship is more of an information transfer, which is totally appropriate, and there's nothing wrong with that. You just at an annual meeting, we like to say after annual meeting we'll debrief within as a team, and the bar is if you didn't walk away more excited after annual meeting than you did walking in, like it was a bad annual meeting. Like that's the job. Like, this is the best version of the update.
Fair enough.
So and that's important. I will sometimes ask, like, please give me the best version of this, whatever the situation is, and then we'll unpack it. But help me understand what's the best version of it. So that's important. I think if you're an asset like allocator, if you've got one person, two people running your private portfolio, and you've got 30 relationships, the math only works so well for you to be, and you're not based geographically in a place where you could actually see somebody more than at the annual meeting. I think that's a big part, I think, of how a lot of LPs operate, and it's understandable. And I think it's the information that is more difficult to gather in that mode is this stuff around partnership dynamics.
Do you feel like you have a good sense of healthy partnership dynamics with limited engagement?
Well, we strive to have engagement, right? And we also try to be respectful, because ultimately we want our investors investing and not hobnobbing with us as investors. So we try to be value added in our time together, right? And so part of that is we co-invest alongside them. We'll connect in. Our investor base is philanthropists as well as athletes and celebrities, and so we'll try to bring those people in where we think they can add value, lightly. But those are all strategically also opportunities for us to be in relationship, to gather information. And so that's part of how our mission to serve those LPs also strategically allows us to be, to gather information in a way that would be more difficult if we were more passive asset allocators. And it's so we have I guess the way to say it is we have an active LP strategy.
Got it. Like on average, how many times do you see a GP of yours that you've invested in?
I can tell you, like we've got 25 core relationships. It would be natural, and we don't change our relationships every fund. It'd be natural to sort of like, all right, we got 25, let's like find one or two to change out. We met with 800 managers in the last 2 years. We did diligence on about a quarter of them, deep diligence on about a quarter of them. That's one aspect. That's not quite an answer to your question. The other version of it is we spend a lot of time in our community, and we include our GPs in our community. We did, I think, close to 100, I think 80 to 100 events last year. We're a small team, but that's one way that we are together with them. This quarter, I think we've done over 100 just one-on-one meetings with GPs.
Huh.
So active.
Yeah.
There's just no shortcut to it. And so we're a small team of 25 people. We've got about half the team on the investment organization. And so, we're just out spending time with people in a way that makes sense for them.
So you would probably agree that right now in this current time, in this current moment, it's pretty hard for a first-time fund to get off the ground.
Yes.
Okay. What advice would you give a first-time fund manager out there raising capital at this moment in time?
Yeah, it's back to that it's similar to and parallels the advice to a founder raising capital, right? It's fundraising is sales, and sales is listening for needs and wants and offering a solution for that. And in this environment, I think LP fundraising has always been difficult. It was artificially, quote, easy because there's just so much demand from supply of capital demand for venture from LPs. And it was there was such a rush to get access to tech or venture, that the dollars were less discriminating. So it got a lot easier to sell because like the need was venture. Are you VC? Oh, great. Can I invest? Right. I think the needs have reverted to just a more natural place where people are looking for outsized returns, not just like VC. And so to get that, how do you promise it? Well, if you're your first time fund, you have no track record to point to. Even if you had a track record from a previous firm, in the new firm, something's different. Otherwise, it wouldn't be a new firm. So you've got to explain the differences. So the advice we give is like expect it to be not hard. There are hard things in life. Anybody operating in this venture capital world shouldn't bemoan their difficult life, but expect it to be non-trivial. Expect to go in needing to be thoughtful and purposeful. You're going to need to have a lot of conversations. Think about the hit rate of your conversations. Who knows what the rate will be, but you're not going to be 100% on your conversations. So don't expect it. Don't go in thinking that each one's going to be 100%. So allow for that. And then I think also don't be transactional in it. I'm amazed by how many GPs don't follow up afterwards. They go in for the pitch and if it was successful, great. If they like it, they're going to follow up with me. Actually, like LP probably, just like when you're a GP, you meet with a lot of founders. It is your job to chase the great ones, but it is founder's job also to rise above the rest of the noise. You met with 5 other founders that same day. How does it founder make sure they stay on your radar? Same thing for GPs, stay on our radar in a way that makes sense for us, right? And that's the trick of figuring out how to make that connection so they can stay in touch.
How does a GP know that you're interested and that you want sort of these multiple touch points before you even cut that first check?
Here is the difference in nature between LP and GP responses to founders and GPs. LPs have almost no incentive to say no. There's almost no penalty for just waiting to see more. Come back more. Except it just uses my time. But aside from my time, there's no point in me being the first check-in. I'm not the only investor. I'm likely a small investor for you. By definition, all your investors are small investors as LP to GP. So I think as a GP, if you understand that that's their incentives, then you need to rise above the noise. You need to be patient. You also need to try to ferret out. And I think it's helpful when GPs ask direct questions like, tell me, what is your target? What's your typical, do you invest in first-time funds? And if they ever do, they should say yes. But if they never do, it's not like, do you invest? Do you ever?
Right.
Have you ever once? Because if you never have, then thanks for taking this meeting, but maybe I'm not such a fit, or I won't follow up as much, right?
Right.
So qualify them as a potential investor. It's not useful to say, how interested are you? Because I think that's you can't get a yes.
It's a little vague.
But you want to get to the no as fast as you can.
Right.
And to me, the qualifying that you can do as a GP is trying to hear the friendly no in there. And the friendly no from an LP is almost never a no. It's, this isn't quite the fit for me, which is a no, right? But they mean it could be yes the next fund. It probably doesn't mean yes later on this fund, but you never know. Things change. The entire economy can change. They may have a ton of liquidity or a ton of illiquidity, and all those things change. So I think that's the other advice I'd give, observing from the emerging managers that we do work with. Some are really thoughtful and treat it like a sales pipeline. Like they have a CRM, it could be just a spreadsheet, but they run a process. They don't just keep it in their head. They don't just wait for a random introduction or a favor here and there. One of the GPs I work with, he scraped my entire LinkedIn, which is frightfully large, and looked for every single relationship, LPI, that might be interesting. He filtered it down to 20, which is a lot, that asked me, would any of these be relevant introductions? And do you actually know them, right? And I filtered down more, and I said yes to these X number, and he's like, great, I'll team up. And within an hour, I had 10 customized emails that I could just forward from him that were specific to that firm, any context that he got from me on how I knew them, and that I could just press forward, hey, would you be interested in meeting so-and-so? I think they're really interesting. That's the work.
Yep.
That's sales. That's pipeline management.
Yep.
It sounds similar to somebody taking an intro or asking for an intro, but it's fundamentally different.
Yeah. No, that's interesting. What happened? Do you know?
They ground it out and raised in a really difficult environment. It was a fund too in that case, but not a small fund. And it just takes time. And it wasn't in their first fund. I'm sure it was a difficult process. Fundraising is not difficult. It's not hard. It just takes time. It takes lots of reps. It's a low yield effort.
What do you think most LPs get wrong when allocating capital to the venture capital asset class?
Lots of different kinds of LPs. I think that there was an influx of LPs new to venture over the last, say, 5 years leading up to COVID, right? Where we had a great boom in private IPOs and growth and illiquidity, which meant for better private returns. And I think a lot of family offices, a lot of other allocators that were new to venture came in thinking that the headlines they had read was median. And it turns out that you have a wide dispersion of returns in venture, and median venture actually is only so-so.
Right.
It's actually
pretty bad.
Actually, relative to the risk you take, it's not that.
It's very bad actually, relative to the risk you take.
Yeah. So I think that's one of the biggest mistakes LPs made coming in. And I don't think those lessons were learned. There's a lot less LP demand today, which is why it's hard for first-time funds. It's hard in general for GPs to raise right now because there's less demand. The good news is that the quality of capital that is still seeking access to venture is higher in terms of what they understand they're buying. It's a more educated LP base, the ones who are still left, right? You have far fewer tourist LPs coming in because their nephew told them about, the iPhone, right? Some technology thing. Like, I should get some technology. A little less of that, so less noise.
Are there any firms that you regret on passing the anti-portfolio question? And are you willing to share which firms they are?
Oh, goodness. What firms can I actually see? There are
will
many.
Require some humility on your part.
There are many, but...
Top three.
No, there are many, but I don't think I can name them.
Oh, you can't? Okay.
But I can go back further into less relevant times.
Okay.
Where it wasn't a pass. Well,
and maybe more of the insight in terms of why you passed, if you remember, and what do you think you got wrong, but then they outperformed, which obviously when we're just always trying to get better, what it did for you in terms of changing your how you operate as a LP. Yeah.
Okay. I'm actually not going to name firms, but I can give you specific examples.
It's okay. We'll just flash random firms up there and guess. Robin will do.
He's talking about.
Yeah, exactly.
There have been several new firms. There's countless new firms that were unproven investors who turned out to be great, and they're just unproven.
But new firms are unproven.
They're unproven.
Yeah, they're by nature.
Yeah, by nature.
Yeah.
And so I don't think we got this wrong, actually. I think so what does it mean to get it wrong? We actually misread the information available at the time. So that's harder. We miss a lot of things that are later successful all the time.
Sure.
And that's kind of part of the fun of it. That's the fun of anti-portfolio, because you get to be around all these cool things. That's my fun. Lots of fun stories as a GP, certainly as an LP. But misreading or having a different read on the situation.
Can you give an example?
Yeah, I can give you one on an existing relationship.
Okay.
A firm that had been around for quite some time, had been through multiple generational transitions. So not just one, but multiple generational transitions. We were trying to correlate, as we always do, the performance of their funds with the people involved and the strategy today.
Okay.
And it's difficult for all the reasons I said before. And layered on top of that, they had kind of succession that they were going through, and we had to read whether the new partners that were taking the firm forward were sort of the right ones to bet on, and how much of the performance from the past was due to previous partners
Right.
for good and bad, and new partners for good and bad. How much bad stuff can you blame on the go forward team? How much good stuff can you credit them with? And how much good stuff are we losing from the previous team? And it's a little surprising it might be a little surprising that as an LP, we have a lot of information over time, but our best information is what we get today. And so if you ask a question, whose deal was this? It turns out it's often a nuanced answer. But when you look at data, you kind of just say, oh, it's this person's or this person's. So going in and like actually separating the data to enough nuance to actually appreciate who actually helped with that, who didn't, did it matter that this person was in the partnership? And I think we underappreciated the team, the benefit of the partnership, and overemphasize individual partners in that case. And even though they lost some amazing investors in that transition, they moved on, right? They stopped investing. The new partners had been actually a more important part of the previous success, even in their younger years, than you could see easily from the data. So we didn't get it wrong, but it's harder to appreciate. It's easier to appreciate that later with their later success.
Do you think actually more data is helpful or not helpful? Because
we debate this internally all the time.
Okay, yeah, because that's what I'm getting here. Is
this is probably back to your question on imposter syndrome. I'm a fan of torturing the data. I'm a fan of finding 1,000 ways to fail, or more importantly, finding 1,000 ways to not succeed. Right. So I am a fan of trying a lot of things, looking at things as many possible ways, as many possible different ways as possible, so that on the off chance that there's some marginal insight from one of those things, and like I'm not looking for a revolutionary insight, I'm just looking for the marginal insight, and that's back to like what's interesting about LP world. In LP world, we don't get the benefit of a single outsized power law return that covers all of our mistakes.
Right.
Like it's much more like limit hold'em poker, where you've got to like read the table and like win your money hand by hand. Like, and every marginal advantage, every little insight into he has a tell, you're not going to suddenly be rich overnight. You don't win the whole pot, but you start chipping away, and that's how as an LP you have to make money.
Okay, we're going to transition into what I call fun questions.
Oh, these are not fun. Those are fun.
No, these are like. Well, what's interesting about the fun questions is the fact that you don't really have to think.
Okay.
And you just have to answer just by instinct.
Okay, lightning round. Got it.
Yeah, lightning round. Here we go. What's your favorite color?
Blue.
What's your favorite fruit?
Mangosteen. I almost said mango. Mangosteen.
Mango and mangosteen, or
no, just mangosteen.
Okay, it's good fruit.
Hard to get.
Very hard to get. What is your favorite animal?
The first thing that comes to mind is capybara, because my 8-year-old's classmates are into it.
Okay. Favorite sport?
Basketball. But you're wearing the Jordans.
It influenced you.
So, favorite sport to watch, basketball. My son is a fencer. I become a fencing dad. An inordinate amount of my time is spent around really smelly fencers. So
Okay.
I used to say fencing is my favorite sport.
Okay. Do you like spam?
Spam musubi,
Okay.
not spam email.
Which one of your
I hate spam direct mail.
Oh, interesting.
Direct mail.
You're
Physical
the
mail.
second one on this podcast that's actually related this to spam email. So this is fascinating. I actually mean the food that comes in a can.
Spam musubi. Yeah, I love it.
Okay. Which one of your sons is your favorite?
As the youngest of 3 boys and the father of 3 boys, there's only one right answer, but I can't say it because my children might watch this and be scarred for life.
Fair enough. It's the password to your bank account.
Password 123. Oh crap!
All right. What's the last book you read?
I am in the 3rd book of a trilogy that we call the 3-Body Problem. It's a Netflix special now, but it's an amazing sci-fi book series that we listened to with our older boys during COVID, and then I'm now reading myself. And so I'm on book 3. It's amazing.
Okay. Your favorite podcast other than Conductive Conversations?
Acquired. Easy.
Oh, acquired. Okay.
Yeah.
That's a good one.
Yeah.
But I don't know if it's better than the Conductive Conversations one. All right. What's the last movie or
Depends on
show?
how many hours we're gonna go.
We're gonna go long, man. We're gonna go saddle up, man. Hey, what is the last movie or show you watched?
I'm watching The Last of Us, but my favorite show of all time is The Good Place.
Okay. What is your go-to for downtime?
It's become sadly LinkedIn.
Oh, really?
Which is my first and only form of social media. I've like actually actively avoided Instagram and Facebook and everything, and Twitter and X and everything else. Yeah.
LinkedIn is your go-to downtime.
Well,
okay.
So I should say LinkedIn and Duolingo.
Oh, what language are you learning?
Mandarin, and as of this week, chess.
Okay. All right.
I'm on a 285-day streak with my son.
Oh, wow. All right.
And my other son is 0-day streak. You know who you are.
That's not your favorite one. Or it is your favorite? Oh, okay. Oh, we're not. Okay. What would you eat for your last meal?
Oh, goodness.
And if you say it in Cantonese, Robin can translate.
Oh, I guess Ifu Min.
Robin?
Translated, it's Ifu noodles. Yeah.
Oh, there we go. Thank you, Robin. Thank you for that translation.
Yeah, I know.
What did you eat for dinner last night?
We had ginseng chicken. Ginseng chicken soup with rice.
What's something you did as a kid that you no longer do anymore?
Yo-yo. I was a...
Were you champion yo-yo of
I was not
Peoria?
accomplished.
Okay.
I was not my talents were not recognized. I should say that. But I went deep into the yo-yo multiverse.
All right. That's the fun question part. Now we're going into Ben perspective questions. Okay. People think VCs think at a very high level. I would argue that LPs think at an even higher level when you extrapolate all the that you've talked about.
Yeah.
What trends are you seeing today that you think people are either underestimating or ignoring that's going to be massively huge and impactful? And you just can't say AI because we've already talked about that.
Oh, like
That's like
that is
too
the answer.
easy.
That is the answer. But it is. And that's the okay.
But that's not contrarian, I think, at this point. Would you agree?
No, okay. So I'll connect it at the meta level, as you said, as an LP.
Right.
What's the pattern?
Right.
The pattern is overestimating the short-term opportunity and underestimating the long-term opportunity, right? And so it's the only way that people can do irrational things is to overestimate the opportunity. So founders need to go do crazy things. GPs need to go believe in founders doing crazy things. You've got to go along in AI. Yeah, that's obvious. There's a reward for that. The risk reward is clear. And by definition, the pattern as an LP I think we can see is clearly there's too much investment. Clearly, there shouldn't be as many foundational models. There shouldn't be as many legal AI tech companies, defense tech. You go down the list of any category, there shouldn't be as many as there are. Just like there shouldn't have been 20 search engines. Just like there shouldn't have been 20 free email providers. But should have is not the right word, because that's how you get the innovation. That's how you figure out the best one. That's how the competitive market creates. It turns out that individual investments may turn out poorly, but as an asset class, actually, it was great to flush money down the toilet for all those search engines because the one that worked changed the world and generated amazing returns. I think the same thing will happen here, but it will happen through an over-eagerness, over-enthusiasm, an overestimation of how fast things will happen. And I think that's the commonality of today. It's happening so fast.
Yeah.
We are overestimating.
So what do you tell your three boys growing up in the AI age, how AI will impact them? How do you think about that?
I don't know how it'll impact them long term. And even 10 years ago, my partner, who was talking and thinking about AI, was an early thinker in this space over the past decades. He was saying, in 10 years, I don't know, not in 10 years, 10 years ago, he was saying, when your kids go to college, which is in 15 years from then, I don't know if the computer science makes any sense anymore. Knowing that I study computer science, I think, the AI will do the programming for us. And 10 3 years ago, that was a nonsense thing to say. But 10 years ago, it was super nonsense. And
I agree.
I debated with him, I explained to him why he's wrong. And actually, there's all a science. There's actually a science behind computer science and programming is a thing.
He seems very right now.
I think he's what we think of as programming.
So do you think it's silly to send your kid to like coding school now?
I think coding school, the vocational coding school, is far less relevant. I think computer science will remain highly relevant, just like the traditional sciences are still very relevant, even if they aren't what you do if you're actually a practical engineer or whatever the vocation is. How I translate to my kids say, I don't know what the future will be. I won't predict that there's no value programming in the future, but I do think that like there's so much happening. We're in a time of transition, and like us old people, like we've got lots of wisdom, but we're also stuck in our ways. Whereas they're just coming into the world. Whatever comes out as the standard, it's going to happen in the next X number of years, single digit, in their next high school, college, and early career lifetime. How cool to be able to come into their profession, their careers, when the next stage is getting set. So my encouragement to them is just like, get involved, like just play with this stuff. It's like all toys today. And you're not supposed to be a titan of the universe. Your access to this is universal. So there's no barrier. So just get involved and play with it, because something here is going to work. And if you got to be involved early, that experience will be incredibly valuable and it'll compound over time.
I agree with that. Ben, I'm curious, how do you think success has changed you in any way?
Not at all. I haven't been successful.
Okay, how has not being successful not changed you?
Life over time, I have changed. I've experienced some success. I've experienced tons of failure. And I don't really honestly think of life in terms of success and failure. I have.
Do you think your definition of success has changed over time?
Yes, it has. Okay. It has changed over time, because I've been able to, like, the blessing I feel like I get to experience repeatedly in my life is being able to see the blessing and opportunities no matter what happens. And
So how would Ben Choi in 1998, graduating from Harvard, have defined success versus today?
Probably power and influence. I was never money driven, but there's a financial aspect to it as well. I don't know. I'm not that different of a person, but it's just hard to appreciate when you have less experience what it is to enjoy experiences and to learn from failure until you've failed a lot. Like it's just a pattern. And so I don't think it's like a different perspective on life. I think it's just a richer and deeper, which is so fun. And I hope that I get another, X number of decades to keep on doing that.
Silicon Valley can often be a bubble. I think you'd agree with that.
Mm-hmm.
What do you think you believe that others don't, that make you really unique?
Oh, it's hard to be unique when we live in a world full of unique people. I'm unique because of who I am and my unique experiences, but that doesn't necessarily make it interesting or important.
Yep.
I think Silicon Valley is filled with bubbles, and it's not by accident. It is what makes Silicon Valley possible. It is because we have exuberance and lots of failure that you can afford to have all the experimentation of contrarian ideas where interesting different things can emerge that are by definition different, because if they weren't different, they would have already been scaled and the standard. So I love being kind of my own different, unique person. I don't think I'm from central casting by any world that I operate in. And I love that I get to lean into those, my unique story as my differentiation kind of in the relationships that I have and the work that I do.
What's your superpower, Ben?
I used to say being curious, but you're more curious than I am. It is asking questions. My superpower is figuring out how things work.
We can share the same superpower, Ben.
No, you've checked that box.
I never said it was my superpower, though.
My big brother became a doctor. I mean, you said you were curious.
I am curious, but I never said it was a
that takes
superpower.
I can't be curious.
Actually, I don't think it's my superpower.
What's your superpower?
It's funny. It's not something I thought was a superpower until more recently, which is work ethic.
Yeah, you have that.
And I never thought that was, I was like, oh, everyone works hard.
Yeah. Turns out nothing.
Actually, not that true.
Yeah.
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 Actually, not that true.
And I've seen that. Yeah. I mean, that's totally true.
Yeah. Okay. So last question for you.
You might sink into the sofa.
That's right. Because I was telling Robin that when I sit on this crack, I feel like I'm sinking. That's what I said when we set this up. And I'm like, Robin, do you really want to do it here? And he was like, no, it looks great.
Pillow.
Yeah, I feel like I'm like sunk into like 10 pillows here, which is fine.
It's all good.
Just switch it around next time and see whether the person being interviewed also slips.
Right.
Right. Let's see how they handle it.
I know. We should try to interview someone taller than me.
Yeah. Good luck.
And then see what happens.
Yeah.
So, okay, this is the last question.
Okay.
What I think is really interesting, and we'll have to get a photo from you of this, but you converted a VW Bug into an electric vehicle. And this is really interesting to me because it doesn't show up anywhere on your LinkedIn that I'm aware of. When I looked on your LinkedIn profile,
Yeah, that's a miss.
I always look for something that is not apparent on somebody's LinkedIn profile.
Oh, that's interesting.
And I know that you converted a VW Bug. It took you
way too long.
Okay.
6 years.
6 years to convert it. And
Nights and weekends only a couple times a year over 6 years.
and you did this yourself.
Straight. Yes, I did the work myself.
Okay. So can you tell me why you decided to convert a VW versus
Like a cool car?
an Audi or
Like a Porsche?
I'm not saying it's whatever. Just curious why you picked a VW Bug. And then now that I've learned it took you 6 years, why did it take so long?
Why am I so bad at it?
Yeah. And then why, like, how has it been driving it? Around now.
Okay. So when I turned 40, life was work and family, and not enough investment into Ben. And it wasn't a realization. I decided, I need to be an adult and take care of myself. So started working out, started eating better, and felt like I needed a hobby, something. And I wanted a hobby that I could do with my kids. I think golfing is lovely, but it takes away from home as opposed to be at home.
Right.
And takes you away for hours and hours. So I thought working on cars would be fun. I like to think of how things work. I'm not a car guy actually, but I'm a kind of DIY around the house person. So it would be kind of fun to work on a car. And so the two options, I first went down the path of looking for car restoration projects.
Oh, so it sounds like it didn't have to go a conversion from ICE to battery power.
It started with restoration.
Okay.
And then I went down that path and realized, and I thought, what would be a fun car, like an old Porsche or something would be really fun.
Of course.
To restore.
Yeah.
It turns out restoration is like this. It's like renovating a house. It's like the worst thing possible unless you really, really love that thing.
Right. And you'd never done this before, so you didn't know you loved it or not. Okay.
I had no idea if I'd like to, and I had no idea what I was doing either. So you need to know what you're doing to restore a car.
Be kind of handy.
Yeah, it's not just handy. Like it's like custom specific to that car.
Okay.
Whereas new construction houses, you just build a house.
Right.
So conversion.
So why'd you pick the VW Bug?
So it turns out, so I heard about converting cars to, which I didn't know was a thing, but it turns out there's like a whole subculture of people who do this.
Huh.
And the Bug actually is a common car to convert because it's such a simple car. So it's a really, really simple car where you can work, it's easy to work on bugs, right? So it turns out because it's easy to work on bugs, you can also literally just drop out the engine and put in...
Which is the rear engine.
The rear engine, right? So the rear engine pops out. It's the same engine as like a Porsche 911. So it still had the 911 thing. Actually, how it got from 911s to if you work on 911s, you also work on Beetles, on vintage Beetles.
Right, I don't think most people know that.
So I got into that little sub-world.
Is that how you sell it?
What?
You have an engine of a Porsche you had?
So I went and found a dad who had spent 6 years restoring a 69 Beetle, beautiful red little 69 Beetle, as a project for his teenage daughter. And by the time she turned 16, she had no interest in driving. She Ubered everywhere. And so he just wanted to find somebody, an owner, who would appreciate the car that he had restored for his daughter. So I found him on Craigslist.
Wow.
We drove over to Sacramento.
So it was already completely restored.
Fully restored. Beautifully restored. And I told him what the project I wanted to do is I was thinking about doing that, but this project took so long. You do it. And I bought it for really inexpensive. I remember, I don't know anything about cars.
So this car you bought was completely restored.
Completely restored. We drove it once
Yeah.
with him. We drove it once, putt, with my two boys in the back seat, and you putted around, fun little car to drive. No power steering. It's like difficult. The brakes like are fine for that, but they're like terrifying brakes. Like they're not good. And then as part of the deal, he agreed to transport the car to me from Sacramento to Palo Alto. In exchange for allowing him to take the engine out, because the engine actually is a Porsche engine. It's really valuable. I didn't want the engine, and I also didn't know how to take it out. So the owner took the engine out and then towed the car to me. So that was the first step to get the car.
I've never heard of this. This is amazing.
It's the thing, and so that was probably the engine's probably worth like a third of the car's value. Then it turns out that there is a process. There are shops you can pay like $80,000 for a shop to convert a vintage Beetle, and they're really cool. So I got online, and those shops will also sell you the parts. So they know what they're doing. They will also sell you. So I got a pallet full of parts, which is basically a golf cart taken apart and like in boxes, and then and no instructions. So
and how much did this cost? This is $80,000 for them to do it. How much were the parts?
The car cost $6,000.
Okay.
Restored, which was a steal. I think it probably should have been like $10,000. And then,
but it didn't come with an engine because you took it out.
But it was delivered to me. And then roughly $10,000 of parts: the motor, the computer that controls it,
right,
and a bunch of wires,
and the batteries,
and then $10,000 of batteries.
That did not include the batteries.
$20,000 of parts.
Okay, and so you're in for 26 already.
It's $26,000.
Okay.
I just turned 40. We had two kids who rode the Beetle one time, and then I had a clock because we found out that we were going to have our third boy when that project started, and so I had a little time before he came, and then once we had a little baby in the house, like less time. That's why, like basically, my birthday and Father's Day and a couple other weekends a year, I'd work on this car. I had no idea what I was doing. Boys got to help a little bit here and there.
Are there any YouTube videos that kind of?
No, nothing. I haven't posted anything on YouTube.
Okay.
Just I have videos of the kids and things, and over 6 years, I made it in time for our youngest boy's 6th birthday for the car to work. And so the car runs, but is a 1969 Beetle. I bolted in the seat belts because they're not standard. The back seat like sits on top of the controller and the battery system. Well, there's 600 pounds of batteries that sit in the luggage space right behind the back seat, which is where my kids sit.
Okay.
And
so they're sitting on batteries
right in front of 600 pounds of batteries that are just bolted in by me into the little sheet metal in the car. And the car
sounds safe.
The car probably top speed was like 50 before with the internal combustion engine. This thing, even just an Alma, I can get it to like 55, lickety split, like 100% torque. So the thing accelerates like crazy. There's no airbags. There's like basically just sheet metal between you and the pole you're going to crash into. So it is a complete death trap.
Nice.
So the family's ridden a handful of times.
Sounds fun, really fun.
The original idea was I would use this as my daily driver and drive the kids to school. That's my commute. And go to the office. And I barely drive it now because it is like super unsafe. It's super fun. And when we drive it, we live in Los Altos.
Yeah.
There's actually, in downtown Los Altos, we just moved a year and a half ago, and there's this huge mural that's like 3 buildings wide that says Los Altos and has a red Beetle on it. 1969 red Beetle. Like next to the Safeway. It's awesome. So we felt very welcomed to Los Altos. We moved in.
Wow.
But when we drive into Los Altos, just like a couple minutes away, right in between our houses, like people will sometimes notice the car and they'll glance. It's like it's a cute little red Beetle. And then once I drive by, they'll like turn back.
It's eerily silent,
because
right?
it's like the car just coasted by them.
Right.
And that's the fun of the car.
So let me get this straight. You spent 6 years not even restoring the vehicle, just changing it from ICE to electric.
Just electric. Yep.
You dropped $26,000 for this whole project, and now you barely drive it.
No, and now I get to talk about this story on podcasts.
There we go.
To millions of viewers.
I'll be impressed if we get to millions. We're not at millions.
Well, we haven't posted this yet. Yeah,
7, 8 viewers?
This one.
Okay.
But that's a miss that's not on LinkedIn. I may need to post something about my car.
I always try to find one little nugget that is not obvious on LinkedIn.
Yeah,
and
it's
I
a good
remembered you had a electric VW.
Have you
bug.
not seen the car?
No, you said you would show it to me,
And I
but
never
clearly
did
you
it.
didn't drive it
I never made good on
to
the
my
bumps.
living room.
Yeah.
Yeah.
We are we've had an electric car for now for 8 years, but we're only a month into owning one that actually is a proper electric vehicle.
You've always had cool cars. I remember when I first met you, you had a TT.
Yeah, a little red TT.
And I was like, dude, this guy's got good taste.
It was a bargain Craigslist deal.
Still good taste.
First fun car I got to, yeah.
Yeah.
Super cheap.
Not a 911 engine though.
Not
Yeah.
911.
I think that thing was underpowered,
Yeah, underpowered.
but cool looking car.
I thought it looked cool.
It was-
I think
it's a nice
people who know about cars don't think it's a very cool car.
It's all good.
Imposter syndrome.
It's okay. But I remembered it. See? I remembered it. All right. Well, join me in thanking Ben Choi for yet another interesting conversation. And join me next time for another Conductive Conversations podcast.